let's look at, the big picture for financial markets. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we are approaching the end of the year, and when we look here at, the sectors, the best performing from the lows is industrials. The best performing vis-a-vis the 52-week highs is the utilities. Looking here at, the megatrends, blockchain is the top performing from the 52-week lows, but, we do have a minus 55% pullback, so it's pretty, substantial. The worst performing theme vis-a-vis the lows is external bionics. Looking long-term into the future, do I think that bionics has a future? Definitively. But this is, a theme where there's a lot of uncertainties. There will be some huge winners, but also a bunch of losers. So it's always been like that for new industries. When the first cars came to market, there was, tremendous uncertainty. And most car companies, they did go bankrupt. So it was very hard to know who would be the winners. But those who became the winners, won in a very, very, very big way. So that's something to think about. Because you are not going to get, thousands of percent gains by, buying the SPY. Nor is it easy to become passionate about an index, It's very hard to, look at, let's take the XLK, like that, and be, really passionate about the XLK. It's way more easy to become passionate about a specific company, like Nvidia. Okay, so let's just look at what's happening here in the markets. So we will focus on the charts in this video, just to be able to churn through a higher number. Okay. Yeah, so the SPY, it recently made a new all-time high. That is obviously bullish. But it's with a caveat that we still are obviously in a bubble. And that's like across a bunch of metrics. So regardless of the arguments you hear for why we should go higher, you could easily make a case that it is priced in. Like the liquidity, that is priced in. The interest rate is priced in. You could make a way better bearish case for the SPY than a bullish one. Yet, the paradox of the SPY is that it just made a new high. So that's why, I think it's very important to look at, the long-term picture, because when you've all heard the quote, let the trend be your friend. That does not mean looking at, the last candlestick alone. You need to look at the current reading in the context of the history. And when we look here at, the distance from the 20, 50, 100, and the 200-week moving average, and here we go way back to 2001. That's obviously a lot. We see that we are, objectively speaking, right here and right now on the high end of that range. When we look here at the MACD, this mega bullish rally, it created readings that we have not seen in literally decades. So it's an anomaly. It's been extremely bullish as far as, price moves goes, but still it is an anomaly, and that's something we just have to respect. We do see deterioration on the MACD, notwithstanding this new all-time high. Let's go here to the daily data points. As far as, accumulation distribution, we do have some slight bearish divergence between this price action and that indicator, but nothing like dramatic. But yeah, bulls are in control, but we do have readings that are just very excessive in one specific direction. So if you're looking at this and recently turning more bullish on the SPY, then you are doing the opposite of what the market wizards, the best investors of all time, recommend, which is the general message of buying low and selling high. Be fearful when others are getting greedy. So let's look at the bond market, the TLT. So we did have this very interesting pattern that I highlighted previous weeks. We did have this head and shoulders pattern. And then the bulls, they did try to neutralize it, but This week we did see quite the candlestick here to the downside. So the bears are making a bit of a power move. So this is very interesting. I would say that the bulls still have an opportunity to sort of push higher. On the daily data points, we don't have any like very dramatic breakdown. But this is definitively one that an ETF where we can see a bigger turf war between the bulls and the bears, because it's a huge deal what kind of patterns we get here. When we look at the longer term history here, letting the trend be our friend, head and shoulders pattern, they have a long history here with the TLT. Here is an obvious head and shoulders pattern. This one is a bit different. You could argue that maybe this is a bit more of a convoluted head and shoulders pattern. We did see some breakdown, but we did certainly not get that measured move. So basically, head and shoulders, they are a big deal for the TLT. They keep repeating and they do matter. So this is basically a full bore declaration of war here between the bulls and the bears, which could become quite interesting. Let's look at gold, like that. Where is gold? I like to look at the futures because the futures, they trade more hours than the ETF, like the GLD, so you get more data. So yeah, let's just go here to the daily data points. Well, gold is just sort of like very range bound. You do have that cluster of resistance levels above us. We did test the blue 100-day moving average here. Quite surgically faced rejection, like there, which is to be expected because you see here that that moving average has been such a big deal recently here. And here we can see the blue 100-day moving average. So this is obviously a very big deal level. But yeah, with gold, long term I am bullish. There's obviously a lot of resistance levels above us. So it's another place where we would expect a more heated battle between the bulls and the bears, because it's a huge deal for the bears to see a breakdown. The bulls obviously want to break out. So it's at these levels where you can get these epic battles. Okay, so next let's look at some world markets, in stocks. So let's look at China. So China, it is at this very, very key long-term support level. So let's look at it like this. So let's draw it in. So here you can see support, horizontal support, horizontal support, horizontal support. So for such a long time, this has obviously been a very big deal level. I think that we could make a very strong case for the future of China. Hence, you could argue that this is historically not been the worst place, price-wise, to get bullish on the FXI. Then again, this is another situation where we expect a more fierce battle between the bulls and the bears, because the bears, they want to see this support level break clearly, and also turn into resistance. The bulls obviously want the opposite. They want that firm support. So yeah, so this is another place where we have this major turf war. So that is like a theme that's repeating here. So let's ask an interesting question. So let's say that I was awarded 100,000, but with the condition that I had to be long one stock market. Would I then pick the FXI, being long China, for, let's say, 5 years? Or would I be long the S&P 500, which is America? So here is the S&P 500, which is at an extremely high level. So if the condition of the reward is that I had, to be long for such a long time, would I feel comfortable being long the S&P 500 for 5 years at these levels? I wouldn't feel that comfortable. I think I would pick China. China is at a multi-decade support level. It's at a relatively, it's on the lower end of this price range. So that's something to consider. So yeah, this is one of the reasons why I like to look, more globally at stock markets, because if you only look at the SPY, well, what was that? okay, the SPY, then you don't see stuff like that. Let's look at VGK. Europe, the Europe stock market is very different from the SPY. So you can see here with Europe, you have these major time cycles, huge, which means that Europe works really good in a long, short portfolio. By the way, given this time cycle nature of Europe and this deterioration we see here, it certainly does have a history of working out, from a bearish perspective. Temporarily, can be long for periods and then have, short bias. Let's look at some energy ETFs. So let's look at, the solar industry. So this is, one example of, an industry that had, this extreme bullish momentum. It was just absolutely, without any limits, super bullish. Then the bears take control. So yeah, it goes to show you that it is at times when things are peak bullish that you need to sort of be a bit cautious, There's a reason why people say buy low, sell high, because this theme has been shown across industries, across asset classes, you name it. Euphoria has a way of morphing into panic, bearish panic. Anyway, we have gone from bullish euphoria to bearish panic to now we are basically consolidating. So this is one of those that looks interesting. It's not like a roaring bullish setup at the moment, but you could argue that it's at support. It's at a level in this price range which it is interesting from a more speculatively bullish perspective, but it's not like a roaring trade at the moment in any really specific direction. Looking here at uranium, okay, so you do have this purple 20-week moving average. Unfortunately, we are now below it. So you can see here, that these moving averages are a really big deal because you see the bulls really tried to push hard upwards and the bears really tried to push downwards. So there's a big battle here on that level, and that's because it has been relevant in the past. If you see here, quite recently, surgical resistance, almost surgical resistance. Back here it was, support. And this is something that, both teams, they know that. They know that the bears, they definitively want to see a firm break, firm resistance. Bulls obviously want to get above it. On the daily data points, it seems like the blue 100-day moving average is rather important. So yeah, uranium, and then you have solar energy. So let's look now at the less clean alternative, the XOP, oil and gas. So we are seeing some a bit of a rally here. This is from a low level, and you do have that long-term horizontal support. When it comes to this whole energy debate, I think it sort of has become more complicated as of late because the major issue for the environment is, human population growth. I think that this focus on carbon, it is relevant, but to an extent it is also a distraction from a much bigger issue. And that is that, we are sharing this planet with a bunch of other creatures. And that is the real important thing. And the biggest challenge for the environment is our financial system, because it must have growth. The primary reason why the S&P has been making new highs after new highs since the end of World War II, the primary reason is population growth, and growth is something that the entire financial system is dependent upon. It must desperately must have growth. But then you have to ask yourself the question: does the planet need more growth from us? No. Does America? No. There's no location that actually needs it. As a matter of fact, we do have like a mass extinction event in the animal kingdom, which is obviously very bad and very immoral. So we need to invent a new financial system that is not dependent on growth. A financial system that rewards preservation of the natural wildlife diversity of our planet. But yeah, a bit of a digression, but it's a very, very important point. Okay, so let's look at some stocks. I think that Apple is quite interesting because, this is interesting more as a short idea, I think. Because this is Apple, okay, up huge. So are the bulls in control? Sure. But then we have to ask ourselves the question, let's let the trend be our friend. Okay, so let's look at the long-term trend here for Apple. So when we look here, decades into the past, and here we have a bunch of indicators. We have the RSI, the distance from the 20, 50, 100, and 200 week moving averages. We are at the very high end of that range. Across these indicators, have we been higher in the past? Yeah, we were actually higher back here in 2004, 2005. But for a long period, these kinds of readings have been risky. Looking here at, the daily data points, if we look here at, the RSI, if we go back here, a previous time we had this reading, it was here, then we went a bit higher, and then we sold off. If we go back here, we had, this RSI and this RSI readings, we went up higher, and then we pulled back. So basically, the current reading, looking at the recent history, it is really, really high. There's a strong tendency for it to result in some pullbacks. Though there have been times where we have even become more extended. But yeah, I think that at these levels it makes sense to at least consider some bearish opportunities. And if you go into the options market, then you can put on bearish trades, which work out even if the stock goes higher, because you can have trades where the option decay works in your favor. So yeah, you can be right in many different ways. But yeah, but obviously it's also beneficial to get the primary trend with you. So yeah, so to sum up a bit here. So what's basically happening in the market? I think in the bigger picture, the major indexes and the major stocks, the big monopolists in the market, they are still making new highs, but we are seeing massive decay underneath. The SPY is very close to all-time highs, but when you look at the megatrends, we have seen on average a very substantial down pullbacks. When you look here at these other themes, like hotel and resorts, you name it, and these are all kinds of different themes. On average, we have a minus 23% pullback from 52-week highs. That is technically speaking in a bear market. That's very interesting. That's not reflected in the S&P, so there is this clear decay underneath. As far as buying low and selling high, I think that it is more interesting to look for bullish opportunities here in some of the beaten down long-term megatrends than to look at a bullish opportunity here in Apple as an example, or any other stock that's at some kind of obscene overbought level, which is way above what the long-term trend usually is. So if the multi-decade trend suggests that we should expect a pullback, then that is way more likely than it going even higher, and creating an even more statistically improbable situation. So yeah. Whatever you do, of course, you do want to let the trend be your friend, with the understanding that the most important trend is the longer term trend.